what we did during COVID, that is the source of all this inflation. And it's going to continue to get worse as long as we continue to run these massive deficits.
Is America heading towards a financial doomsday? Many experts hint so. The famed investor and economist Peter Schiff warns about dangerous trends in mortgage and refinance implication. He suggests that these trends may lead to something more significant in the future. Let's see what it's all about. The Federal Housing Finance Agency's new regulation implemented under the Biden administration changed mortgage costs. The adjustments has generated debate since some borrowers with strong credit may wind up paying more costs than others with lower credit rating. Peter Schiff, CEO and head global strategist at Euro-Pacific Capital, is one of the detractors. In an interview published on Schiff's YouTube channel, the presenter reveals his desire to purchase a property but expressed worry about being penalized if the plan materialized due to his excellent credit score. Just a few missed payments can ruin your credit score, Schiff said. The mortgage rate will benefit from that. Schiff, who correctly forecasted the 2008 financial crisis, highlighted the problem with this move. This new rule encouraged people to make smaller down payment than they might otherwise have made, he claimed. In general, you receive a better rate if you put down a hefty down payment. However, Biden now wants those who don't put down sizable down payment to get the better rates. The new regulation may encourage more individuals to become homeowners, but according to Schiff, it does not look good for American banks. The worst aspect of this is that it will further jeopardize the stability of our financial systems since banks will be compelled to lend riskier borrowers and encouraged to do so, according to Schiff. As a result, more mortgages will fall into default. To control the inflation that has been out of control, the U.S. Federal Reserve has raised interest rates significantly. Additionally, mortgage rates have increased, which means purchasers must deal with higher mortgage payment. The typical mortgage payment for application was $2,093 in March, up 1.6% from $2,061 in February, according to statistics from the Mortgage Banker Association. Simply buying a home in America is not particularly economical. According to Mortgage Bankers Association Associate Vice President Edward Saylor, the affordability index hit a new survey high last month, with both the typical purchase application amount and monthly payment rising on a monthly and annual basis. More than just the mortgage payment has to be taken into account when purchasing a property. In addition, homeowners are responsible for paying property taxes, insurance, upkeep, and repair. Take it from me, I own many. Houses are quite costly, said Schiff. They are a waste of money. When you are in a debt, you cannot purchase a property. Later in August, Peter Schiff drew criticism for citing married women entering the workforce as a contribution factor to the current housing problem. The financial commentator posted a continuous option on X, previously Twitter, beginning with a statement about mortgage rates. The 30 years fixed rate mortgage reached its high in October 1981 at 18.45%. and its lowest point in 2021 at 2.65%. 7.4 is the current rate, and it is growing. Schiff said 40 years of falling mortgage rate plus married women entering workforce allowed home prices to rise much faster than incomes. Some ex-users reacted angrily to the suggestions, with one saying flatly, "Of course, it's the woman's responsibility, thanks Peter. You just insulted every woman who fought tooth and nail to break the glass ceiling, compete in the workplace, and further civilization's progress certainty." One person said, "I can't think of a single woman that's gonna roll with your 1947 take on the female workforce." In response, Schiff said, "That is not what I meant." Here's his justification. To set the stage of his divisive piece, Schiff noted that in 1981, mortgage rates reached a record high of 18.45%. What led to such an enormous figure in 1980s? Excessive inflation. In June 1981, the Federal Reserve increased the federal fund rate to 21% in response to rising oil costs, excessive government expenditure, and an increase in wages. To make up for the declining value of the dollar during periods of high inflation, lenders frequently impose higher interest rates. This implies that everything is more expensive, including housing. According to Schiff, married women worked to help their husbands buy more expensive homes. Women getting employment didn't cause home prices to rise. The home prices increased it. Inflation was what drove up housing costs. With the aid of a new training and job development program under the 1973 Comprehensive Employment and Training Act, as well as the beneficial developments like employer-sponsored daycare and paid family leave. The extreme inflation in the late 1970s and early 1980s encouraged far more women to enter the workforce. One ex-user responded to Schiff's article by saying, "Married women entering the workforce wasn't a cause of inflation, it was an effect of inflation. It became a requirement in the 1970s. Inflation was one of them, but there were others." Correct, plus increased taxes, Schiff said. Real earnings from married men were lowered by taxes and inflation. To make up for the loss, their spouses were compelled to seek employment. The mortgage crisis in the USA is a serious problem. Recently, the Fed has been tightening the monetary policy by increasing the interest rate. The Federal Reserve increased its target federal funds rate by another 0.25% during its July 2023 Federal Open Market Committee meeting, over a year and a half after making the significant policy adjustment. Since March 2022, this has been the 11th rise. The target Fed funds rate changed from 5.25% to 5.50%, the highest level since early 2001. Jerome Powell, the chairman of the Federal Reserve, said that the rate increase in 2023 might not be the final one, and that the Fed is not expected to start decreasing rate this year. The Fed's earning money posture, which was a place since the 2008 financial crisis, has drastically changed from its current rate policy. The Fed funds rate was on the range of 0% to 0.25% throughout most of that time, including 2020 and 2021. As inflation soared in March 2022, the Fed changed course and swiftly increased rates for the balance of 2022 and into 2023. Are the rate hikes nearing an end? Despite worries that the Fed rates hikes may increase in the likelihood of recession, the U.S. economy has shown to be unexpectedly resilient thanks to the labor market's ongoing resilience. The GDP growth rate was 2% in the first quarter and 2.4% in the second quarter of 2023. It makes room for more rate increases in 2023, given that sustained economic growth could keep inflation high. According to the survey by the National Association of Realtors, property prices have dropped by more than 20% of the 3 months running. All current dwelling types, including single-family homes, multifamily homes, and condos and co-ops, saw a fall. Your perception of the situation is incorrect. In the 37 of the 50 largest markets in the nation, prices have fallen by double digit. Overvalued markets anticipate that home prices will decrease by half by 2024. The more price decline are anticipated. It could be accurate given that several western metro areas have already reported home price increase of 0% by 2023. What is the primary issue here? The issue at hand is one of the affordability. The national payment to income ratio stands at 34.8%, much above the highest level observed in 2006 before the Great Recession of 2010, which had its root in the housing industry, and many analysts are worried about affordability. Thus, reduced buyer demands and falling prices are predicted, especially given the current high interest rate environment, which would discourage many would-be purchasers. Many experts, including those at Vanguard, foresee a recession in 2023 when the housing industry in the nation starts to cause an economic downturn. Mortgage businesses are already laying off workers. Residential real estate is still a popular choice for investors despite being expensive to buy and maintain. The fact that the asset is a well-known inflation hedge is one of the causes. The cost of building new homes rises as the cost of labor and raw materials rises, and it in turn helps the value of already owned properties to increase. In addition, buying a home is becoming less practical due to rising property prices and high mortgage rates. And when folks are unable to purchase a home, renting is their only choice. For landlords, this result is a consistent source of rental money. There are other ways to invest in residential real estate and generate passive income without buying a home. There are real estate investment trusts that focus on renting out single-family homes in apartment complexes. Additionally, there are fractional investment platforms that enables retail investors to directly participate in real estate with as little as $100 through the private market if they don't want the volatility associated with publicly listed REITs. That's it, guys. What do you think of Schiff's warning? Let us know in the comment. Also, hit the like button if you like this video. See you with another content. Bye!